Good morning or good afternoon. My name is Dwight Slough. I am the owner and operator of DHS Financial Services that is in Harrisonburg, Virginia. And today I want to take some time to do a PowerPoint presentation as it relates to health savings accounts, to give you a little bit of information about that so that as you're looking forward, I guess it would be as it relates to the possibility of replacing the Affordable Care Act that Congress has been working on. One of the things that the Trump administration has been talking about is the pushing, if you will, of the HSAs or these health savings accounts. So I want to give you some information about that so that if it's an opportunity for you and you're looking for some health coverage, then you have a little bit more of knowledge that would be able to direct you hopefully in the right direction. So we want to look at, as I said, health savings accounts, the innovative healthcare financing that I think is very important for people to become more aware of and acquainted with. As a small business owner myself, I have an HSA or health savings account and a high deductible health plan, and I believe that it just offers more than just being able to help me fund some things that I wouldn't be able to fund, but it also gives me some type of ability to save and also reduce down some taxable income. So we'll talk about that as we go a little bit more into the slide presentation. So we want to begin with where most things usually begins with is problems. So what are some of the problems that we're looking at as it relates to trying to find some type of affordable health coverage that would make sense for us and not break our piggy bank? Well, in attempting to purchase healthcare benefits, individuals are going to face some problems. One of those is going to be the cost. Due to the high cost of traditional health insurance coverage, it is difficult, if not impossible, for many of us to purchase adequate health insurance protection at an affordable cost. I can remember as little as probably 8 years ago, plans that I would quote people for health insurance. We would probably say for a family, you're looking at around $500. I usually do $200 on each of the parents and probably $75 to $100 on the kids. And again, you can't touch that in today's market. It's become prohibitively costly, and that was for a low type of deductible, maybe a $300 deductible. But nowadays, you're going to be paying probably close to that for one person, and you're going to be looking at a $5,000 deductible and higher. So cost has become very, very prohibitive as it relates to people trying to purchase some of these affordable health care plans. That's why you have these subsidies that are being offered by the past administration. Without protection, health insurance protection, the financial impact of a serious injury or illness can be and will be devastating. So you think about how long it takes you to save maybe $1,000. You spend a couple hours in the emergency room, and the multiple months or years to accumulate that $1,000 could be gone in 2 hours. It becomes very expensive when you get sick. Secondly, we have the problem of choice. While managed care has produced cost savings, and I usually associate managed care with these health maintenance organization types of plans, people enrolled in managed care plans generally find their choice of doctors restricted. You're going to have to work with who we have available. There's also an increasing concern about the interference of bureaucracies in the doctor-patient relationship. So you get the government that gets in between you and the doctor and tries to micromanage the healthcare that you need to really be discussing with your doctor. And the doctor should have that final say, obviously in consultations with you. Third, we talk about a problem of control. Individuals who need little or no health care receive no financial reward under traditional or managed care plans, nor is there any financial incentive under these plans for individuals to exercise control of their health care expenditures. So 2 points I want to make as it relates to that. They talk about little or no health care received in terms of financial reward under traditional or managed care plans. When I look at doing a high deductible health plan and HSA as part of that, I would always ask my clients under the traditional plans or the managed care plans, if you're healthy and you pay your premiums every month faithfully and you never have a claim, do you get that money back? Well, the obvious answer is no. The insurance carrier keeps that and says thank you, and we'll renew you at a higher premium for another year so that we can get more money. So there's a question, and I sort of look at a health insurance, high deductible health insurance plan with an HSA. We're going to see some savings there. And so if you use it, you're going to have that savings account that you're going to be able to pull money from to pay day one, $1, medical costs. If you're not where you have to use that type of coverage and you're healthy, then the money stays there and it rolls over from year to year. And we'll point that out as we go through these slides. So again, that first point is, you know what? Here you're going to get a little bit more of a financial reward because you get to keep your money in your pocket until you need it, not paying it out to a health insurance carrier that pockets that money. And then they talk about here exercising control over their healthcare expenditures. There's no financial incentive for that for these individuals. Again, I point out an example that I had a client that we put him in an HSA. He was in the business of flipping homes, and so he got this high deductible health plan, and he had some type of illness that required him to take shots. And so when he was inquiring, because now it's coming out of his pocket, that savings account, to pay for the prescription or the drug and the needle and so forth, he became a more wise consumer. If you have the older plans that were the $20 copays, for the most part you didn't care, because you didn't care in terms of what the cost was going to be, because you were going in there and you were only paying your 20 bucks. And you were moving on from there, and the insurance carrier was picking up the tab. Well, things have changed now. And so with those high deductible plans that the Affordable Care Act has introduced, that money comes out of your pocket first. And so, you know, now you have to pay attention to those types of things. So cost, choice, and control are some of the problems we look at. What's a potential type of a solution? And we talk about it in terms of the health savings account. By combining tax advantage personal saving with the high deductible health plan insurance, you have what we call the HSA, which puts you in control of those healthcare dollars while protecting you and your family against the cost of a serious illness or injury. So again, going back to my previously cited example, you're going to be able to decide, do I want to have X or Y, because now I'm paying it out of my pocket. And again, if you go to any place where you're looking at something that could be expensive, one of the questions we ask is, how much does it cost? Back in 15, 20 years ago, most people that had, especially group insurance, they didn't ask that question. They just went in and said, okay, I'm getting a checkup, here's my copay, anything else that you do, the insurance will pay for it. But this puts you back into control. So let's look at those variables again. Cost: high deductible health insurance is more affordable, while still protecting individuals and their families against the cost of these illnesses, these injuries that could cost you a lot of money. Personal savings accumulated in the HSA can be used to pay smaller expenses, covering routine services until the health plan's deductible is met. One of the things that they note here is, if there are not sufficient funds in the HSA to cover the entire deductible, you're going to pay the difference out of your pocket. So what's the takeaway from that? We need to make sure that we fund these HSAs so that, whether it's a small expense or a large expense, until we get to that deductible, we have money that we can pull out, and we don't have to worry about going into our own personal checking account and trying to pay those expenses. Secondly, choice. These tax-free HSA funds can be used to see any doctor, enter any hospital, or pay any qualified medical expense, even those not covered under the high deductible health plan. These decisions belong to you, not to some medical bureaucracy. So if you have health insurance that doesn't cover, say, chiropractic, or is limited in that, you can take these HSA funds and you can pay for that. Let's say that you have a high deductible health plan that doesn't have medical coverage. Not medical coverage, but doesn't have dental coverage. You can pay for that. Vision coverage, you can pay for that. As long as it's a qualified medical expense, you can take that money out of the HSA account and pay for it. Now, those examples that I gave you as it relates to dental and chiropractic and as it relates to vision, if that's not part of your high deductible health plan that you already have, keep in mind that's not going towards reducing your deductible down. You're still going to be at the same dollar amount in that deductible until you start paying for or having the expenses associated with medical costs that are covered under that plan. So dental, vision, chiropractic, if it's not part of the plan, all of those can be paid from that account. Just keep in mind it doesn't go towards the deductible. And then control. An HSA puts you in charge of how your healthcare dollars are spent. If little or no healthcare is needed, the money in the HSA accumulates tax-free until the funds are needed. And this is pretty interesting and important. Even in retirement, you can use those funds. And we're going to point out through some questions that we provide to you as we get a little bit further into the slide presentation. In fact, subject to income tax, and if you're under age 65, a penalty tax, HSA funds can be withdrawn for any reason. With a health savings account, you control when and how your healthcare dollars are spent. So what they're saying there in the next to the last sentence is the fact that you can pay out of those funds for anything that you want. However, you're going to have ordinary income that you're going to have to pay taxes on, and you're going to have a 20% penalty, which again we'll talk about here shortly. So we go to the next slide. We say, what is a health savings account? It is a tax advantage personal savings account that is designed to provide funds to pay qualified medical expenses, including the health insurance deductible and the co-payments. It is available to eligible individuals in conjunction with a high deductible health plan that you either get through your employer or you purchase it on your own. So you have to have what's called a high deductible health plan. So here's some of the tax benefits that we were talking about. It is, in my mind, the government coming in and saying, listen, we know the premiums are high. So on these health plans, we're going to help underwrite that, if you will, by giving you a tax deduction, if you will, or a tax break. So here's the example as it relates to it. And again, this is what we call above the line deduction, reducing down your taxable income. So let's say that you have, in this example, a $3,000 annual HSA contribution, and your marginal federal tax rate is at 25%. Well, if you take 25% of $3,000, your tax savings that year was $750. So did you really pay $3,000 for that premium for that year? Not really. You netted out the cost to you of $2,250, $2,250. So again, you're not getting that benefit as it relates to these traditional plans that you've had in the past. So again, this is a strong selling point to people that want to sort of knock down as much as they can of the taxable income that they may be subject to paying taxes on. If your employer contributes to that HSA, that amount that they put in is not taxable income to you, and it is not subject to any type of withholding. These funds that are in the HSA, whether again your provider provides it, a family member does it, you do it yourself, you can put these in different types of investments. Again, with those earnings not subject to income tax so long as they remain in the HSA. Distributions can be made at any time. Again, if it's used for qualified medical expenses, there is no type of federal income tax that you would have to pay on it. If you use it for non-medical expenses, these HSA distributions are considered taxable income to you, and they are subject to 20% tax penalty. That is, if you're under age 65 when you take that distribution. So we take and look at it. There's actually two parts, if you will, when we're talking about the HSA. There's the HSA account itself, and then there's the high deductible health insurance plan. Remember, you can't have an HSA unless you have a high deductible health plan. You can have a high deductible health plan and not have an HSA paired with it. Doesn't make any sense to me, but some people do that and say, I'm just not going to fund that savings part. That's up to you. But if I have a high deductible health plan, I'm putting the HSA with it. So let's start with the high deductible health plan first. On the right hand side, you purchase this because again, you have to have it if you're going to have the HSA account. Once you've met that deductible, then the insurance benefits become available to pay for any of those covered expenses. But if you have a high deductible health plan, let's say it's $5,000, that takes a lot of money that could be used somewhere else from your budget that has to pay for these insurance costs, medical costs. So with the HSA, that health savings account, you're going to establish that, and you're going to make tax-free contributions up to a certain amount per year. And now, since we're in the tax year of 2017, if you are a single individual, you can put up to $3,400 a year into that HSA. If you're between the ages of 55 and 65, you can do an additional $1,000. If you have a family plan, you can do $6,750, and again, you can do that $1,000 if you're between the age of 55 and 65. If an illness or injury strikes, these funds can be withdrawn tax-free from the HSA to pay for those qualified medical expenses. So again, what you're trying to do with that HSA funding is you want to cover that deductible out of these funds. In doing that, once that's been covered, then for the rest of that calendar year, which is most of these plans go by, you're not going to have to pay anything out of pocket. So that's the purpose of looking at that HSA. Funds not withdrawn to pay for qualified medical expenses remain in that HSA, and they grow from year to year in an investment account if that's where you choose to put your money, whose earnings will also grow tax-free. The HSA funds may be withdrawn for purposes other than qualified medical expenses. Again, we keep hitting this bullet over and over and over. You can take it out for whatever you want, but it is subject to income tax, whatever tax bracket you would be in, plus a 20% penalty tax. Beginning at age 65, these funds can be withdrawn for any reason, subject to the regular income tax without paying any type of penalty, or you can continue to be used to pay for qualified medical expenses without having to pay any type of tax. So when you turn 65 and you qualify for Medicare, and you do the supplement, and you've got thousands of dollars still on an HSA, you can pull that money out to pay for qualified medical expenses, and you don't pay any taxes on it. But there's some other things that I think that you're going to find beneficial when you turn 65, or even before you turn 65, where you can use that money that would again come out tax-free. So what are some of the advantages of having these accounts? By having the high deductible health plan and the HSA, here's some advantages. The high deductible health plan provides protection against the financial impact of a serious injury or illness. So you're going to know with that major high deductible health plan, the major medical plan, you're going to know what your maximum out-of-pocket is going to be. So if you have a plan that has $6,700, $6,750 maximum out-of-pocket, including your deductible, then you know anything that exceeds that is going to be covered 100% by that insurance carrier during that calendar year. So it's not going to break your piggy bank. Secondly, the tax-deductible savings are set aside in that HSA to pay for future health care expenses, including the high deductible health plan's deductible and out-of-pocket expenses. And one thing I'll say about this in terms of setting this aside in this account, if you have a traditional major medical plan and you have some expenses as it relates to medical costs, and it doesn't exceed 10% of your adjusted gross income, then if you're not itemizing and using a Schedule A, you don't get to take that as a deduction. With the health savings account, you get day one, $1 of these expenses, these medical expenses that are covered, that are paid. So you don't have to be limited to that 10%, anything that it's in excess of that, oh, I can take that as a deduction. With the HSA, you can take from day one, and the first dollar that you put in there, you can apply that, and it's not subject to that 10% AGI that you find on that Schedule A. Third, you can own your health savings account, and as a result, you decide how you want to invest that type of contribution. So again, deals a little bit about the control. Control, again, the fourth bullet point, how these HS funds are spent. You decide that. As needed, these tax-free HSA distributions can be used to pay for qualified medical expense not covered by the HSA or the high deductible health plan. So again, we've sort of made mention of that in an earlier slide. If you need little or no health care, then those unspent funds that's in the HSA, they stay there and they roll over from year to year and they accumulate tax-free. Next, you could spend the funds in the HSA as you choose. In fact, if you needed to pay for future medical expenses, these HSA funds can be withdrawn and used for any purpose, but again, ordinary income tax and 20% penalty if you're under age 65. The next funds can be rolled over or transferred from one HSA to another HSA, which is a good thing. And then here's an interesting thing that I think people are not or haven't thought about that can be used with these HSAs. You may be able to roll over funds from an IRA into an HSA, making additional funds available on a tax-advantaged basis to pay the plan's deductible or qualified medical expenses that are not covered by that high deductible health plan. So you say, well, where would that come into play? Well, when you start these plans, you start with zero in that HSA. But you know what? Your medical costs, an unexpected illness or injury may crop up before you can fully fund that HSA. Well, with these rules and with that bullet point that's there, you may be able to take an IRA and roll that over into the HSA. You are restricted if you're single up to, for 2017, up to $3,400 or $6,750 if you have a family plan. You can put that money in there, and now you have money available to pay for these unexpected medical expenses that before you'd have to take out of your regular checking account. So we're going to sort of end this as we go through the next few slides here, answering some questions as it relates to, in this section, HSA eligibility. Who's eligible? Well, is someone who is not covered by any other health plan that is not a high deductible health plan is entitled to benefits under Medicare. That is, they're not entitled to benefits under Medicare. That is, they're under 65, and they may not be claimed as a dependent on any other person's tax return. So what is a high deductible health plan? It is a plan that satisfies certain requirements as it relates to deductibles and out-of-pocket expenses. So let's just look at the 2017, because 2016 is behind us when I'm doing this presentation. So you have a type of coverage. Let's just look at the individual. So what's the minimum annual deductible these plans have to be classified as a high deductible health plan? Well, for 2017, the minimum is $1,300 if you have just a single individual plan. The most out-of-pocket that they would be able to have for these plans is $6,550. What does that mean? That means in these plans that you know from day one that the most that you'd have to pay out of your pocket, which includes the deductible in most, if not all plans, is that $6,550 if you're an individual. If you're a family, it would go up to the $13,100. That would be the maximum out of pocket, and that would include the $2,600. So these plans are put together. I believe it's the Treasury that comes up with these figures. So again, these insurance carriers are going to have to meet these minimum qualifications in order to have this classified as a high deductible health plan. Except for preventative care, the high deductible health plan may not provide benefits for any year until the deductible for that year has been met. Okay, so what other health coverage can I have and still qualify for an HSA? So there are other permitted insurance that you can have in addition to this and still keep that HSA. For example, you can have workers' comp, you can have auto insurance, you can have insurance for specific disease or illness. And I often think about that in terms of stroke or cancer, some of these critical illnesses that they have policies for. That again provides you with a fixed amount per day or for some other type of period as it relates to the hospitalization. Accident and disability insurance, dental and vision care, and then the long-term care. These are all permitted insurance that you can have with the HSA. How much can you contribute? We've talked about that. 3,400 individuals, $6,750 for the family. It can be made in cash to an HSA that you've established where you have the trustee or custodian. Most of the time you can establish these with your bank. I have found in the past that you probably need to do some interviewing of the different people that are at the bank that would handle these, because a lot of times, or I won't say a lot of times, it's enough that would cause me concern that you would ask some questions and these people don't always have the answers. So you want to make sure that you've got a custodian that has got the training and understands the HSA setup. Secondly, you can go online if you have that technical skill, so to speak. You can go online at some of these banks and you can establish an HSA, answer some questions, submit the information online. You will get a statement back from the bank that you're going to have to sign the disclosures and so forth, and give that back to the bank so that they can have that available for their records if they ever need it. So again, a couple of points here to make. Up to the maximum annual HSA contribution, it can be made for that current tax year so long as the individual becomes eligible for the HSA by December 1st. What does that mean? Well, let's just say in this example that they have here, let's say I go and I don't have a high deductible health plan and I don't pair it with an HSA before December 1st. As long as I have it before December 1st, I can take the full amount, the $3,400 if I'm single, the $6,750 if I have a family plan, even though I did not have that coverage for those full 11 months. However, and it's a big however, there are some things that you have to keep in mind as it relates to that, is noted here. Coverage begins if it's beginning during the year. The high deductible health plan must be maintained up to the end of the following tax year, which is generally December 31st. Or tax must be paid on the HSA contribution that's attributable to the months during which the employee was not eligible for the HSA. So from January to November, if I don't have it where I was eligible, but I get it December 1, and then I cancel it, say June the following year, then I'm going to have to pay some taxes back as it relates to those contributions for those months that I was not basically eligible for it. Again, if you're doing a high deductible health plan and you're pairing that with an HSA, the advantages far outweigh anyone wanting to get rid of that health savings account. So I don't think that would be an issue, but I'm just pointing that out because, again, if we give you something, then we're going to take something away if you don't follow the rules that we have for that. Again, the amount is also going to be subject to 10% tax. So Want to keep that in mind. Who makes that contribution? Who can? It can be, again, from a family member. It can be through an employer. You can roll over some transfer unused funds from a flexible spending account or a health reimbursement account, or from an IRA to an HSA on a tax-free basis. Regardless of who makes that contribution, you own the HSA. How am I taxed on the HSA contributions? Again, it's above the line basis, which means that, dollar for dollar, you get a reduction in your adjusted gross income. So that lowers it, which means it's less likely to be, subject to higher taxes, if you will. Any contributions that are made by the employer to the HSA are not included in your gross income for tax purposes, and they're not subject to withholding. So again, you're a small business owner, you may want to look at setting this up for your employees, because there's some benefits to that. When must the HSA contributions be made? Generally, these contributions are made anytime during the year. You can do it one time and fund the full amount, or you can do it on a month-to-month basis, but it must be made no later than April 15th of the year following the year for which the deduction is taken. So we're in tax year 2017. I have technically, if we're going to use April 15th, because we keep switching it to April 18th for Emancipation Day the last 2 years, but let's just assume that April 15th of 2018 is the filing date. I have up until that time to fund my HSA for tax year 2017. Must I contribute the maximum to the HSA? There's no requirement that you can contribute that maximum each year. Doing so, it's going to enable you to take full advantage of those powerful tax benefits that are provided by the HSA. So there's no reason why I don't think that you'd want to do that. What sources other than the annual contributions are available to fund the HSA? Again, we talked about the IRA. If you have immediate needs, you may want to use that IRA. It is a one-time type of deal. If you look at the bullet point underneath there, what are the requirements to fund the HSA with funds from an IRA? One-time tax transfer of funds from the IRA to the HSA may be made. The amount rolled over cannot exceed the annual HSA statutory maximum contribution for the year, and they give you those numbers right now. And again, these are always adjusted each year. The transfer of these funds from the IRA to the HSA can be done only once during your lifetime. And once rolled over to the HSA, you cannot transfer them back to the IRA. So keep those little things in the back of your mind. When can the funds from the HSA be withdrawn tax-free? Well, here's some things that they can be done for as it relates to expenses. Prescribed medications and drugs. But again, these could include over-the-counter, but you have to have a prescription. Even if it's over the counter, you have to have a prescription from your doctor in order to take that. Doctor visits, labs, x-rays, other diagnostic treatment services, dental, vision, psychiatric care, long-term care services, as well as those long-term care premiums. Again, Medicare Part A, B, and D. The A is your hospital, the B is your medical, your visits to your doctor. Your D is your prescriptions. Medicare HMO or Medicare Advantage plans. You can't take, interestingly enough, the Medicare supplement policy premiums. You cannot take that out of this. COBRA health continuation coverage premiums and health insurance premiums for those on unemployment compensation. So those are some of the expenses that you can take out. If you need to find out more, you can just sort of Google that, and you would see that there's a pretty good sized list of qualified medical expenses. It is your responsibility to ensure that these expenses paid from the HSA are qualifying medical expenses and to keep adequate records concerning the use of those funds. The insurance carrier is not. It's up to you. It's your responsibility. At the end of the year, you'll get a statement from your bank that will indicate that you had so much contributions in there, what your distributions were, and you'll reconcile that on your return. What I recommend for people that are doing it after the tax year has ended, like from January to April 15th, tax filing of the next year, is to, in the memo section, when you're doing that, make sure that you put that it is for a contribution for that previous year, so that it doesn't confuse the bank and you claim it on your return that gets kicked back because the bank thought it was for that year's contributions and not the previous year. So you have to apply a little bit of common sense on that. Can the HSA be withdrawn to pay for non-medical? It can, but again, you have income tax. You have the 20% that you're going to have to pay. What happens if I become ineligible for the HSA? No additional contributions can be made to that HSA. You can still use that to pay for qualified expenses, And again, it'll still be, the distributions will be free of income tax. However, I had a client that went in and had got a new job, had got a new group plan, and made the mistake of contributing to an HSA. Realized that and pulled those funds out. You have to show that on the tax return, but the only tax that you'd be subject to would be the interest that was gained on the time that you had those funds in there when you should not have had them in there. So what happens if you die? If the beneficiary is, and that's important, you need to list the beneficiary, and especially you would want it to be a surviving spouse, because now they become the new account owner and they can use those HSA funds subject to the normal rules that apply to all the other HSAs. So if the beneficiary is other than your surviving spouse, the funds are taxable income to the beneficiary in the year of the death, except for any of your qualifying medical expenses paid from the HSA within 1 year of death. So the beneficiary, if they don't want to have to pay taxes on a large amount, if it's in there, they should pull some of those funds out to pay for those qualified medical expenses that you have. Here's a checklist. Again, you have to be covered under a qualifying high deductible health plan. You need to establish that HSA account, whether you do it online or go in person to the bank to get that trustee or custodian. You can arrange for the payment of the HSA contributions in terms of the subject to the maximum annual contribution amounts. Again, these change for the most part on a yearly basis. You can also be given a checkbook in most of these cases, or they'll give you a debit card. And one of the things that I point out here is, let's say that you're a business person or you're just a family that's taking a vacation in another state. And because I'm in the state of Virginia, I'm going to use the healthcare company Blue Cross Blue Shield. If you travel out of state, most of the plans in the past, some of the ones now talk about if it's emergency only, but I'm going to use it as the fact that if you're out of state and you get sick, as long as you're visiting a participating Blue Cross Blue Shield provider, then they would look at those benefits as being in network. Now, you would not want to put your HSA debit card or write a check out for whatever the service was that that doctor or that physician did for you, because he or she has an arrangement with Blue Cross Blue Shield in this illustration that they are going to accept a certain amount. So let's say that whatever you were treated for, it'd come up to $300, and you use that checkbook that you get with your HSA, or you use that debit card with that HSA, you pay $300, well, it's going to get repriced. The doctor's going to file that with your insurance carrier. The insurance carrier is going to say, well, it's only worth $250, but you paid them $300 out of that HSA account. Well, only $250 was for qualified medical expenses. The other $50 was considered other expenses. So again, subject to income tax plus the 20% penalty. What I recommend people do if they're traveling and they get sick and have to see a doctor is to use a credit card. So they will get from the insurance carrier an EOB, an explanation of benefit statement that says, this is not a bill. You saw this prescriber on this date, and this is what they charged, and here's the adjustment we made. This is what you may have to pay. So if you have put it on a credit card, he can always go back and credit that $50 to that. You can obviously pay your credit card statement for the $250, and then you can go into your HSA account and you can write yourself a check, or you can take the debit and pull some money out to cover that $250 and put it in your personal account. And now everything's cool. You don't have any ordinary income tax to pay, and you don't have any type of a 20% penalty. You just want to make sure that you can keep a paper trail of that in case Uncle Sam comes along and wants to see what you've done there. So that's the presentation on the HSA. If you have any questions or you have any concerns, anything that I said that you want clarifications, you can contact me, Dwight Slough, at the 540-438-0288 number, or you can email me at dhslough@dhsfinancialservices.com. I'm going to be doing additional videos that I think you'll find of some importance. This is going to be posted on my website, www.dhsfinancialservices.com. So make sure that you check in there periodically to see any type of update that I may have as it relates to some other videos. I do appreciate your time and your courtesy for listening. And again, any questions or concerns, contact me at 540-438-0288 or dhslough@dhsfinancialservices.com. Thank you so much and have a great day.